Will rising interest rates cause a recession that ultimately causes a housing crash? At the moment, there's a lot of people out there calling for a recession. It's all over the news, everywhere you look. And at the same time, you have people saying, hey, if a recession comes, the next leg is a housing crash. So in today's video, I want to talk a little bit about why we're seeing rising interest rates, why rising interest rates are actually a good thing for the housing market. It's positive. Yes, I'm a real estate agent and I'm saying higher interest rates are good. We're going to talk about why that is the case. And at the same time, we're going to talk about what happens with interest rates typically during a recession, why we're seeing so much volatility at the moment in interest rates, and why we're seeing interest rates bounce around day by day. So as of today, the latest headline reads that interest rates are the lowest they've been in the last 2 weeks. Now, if you read that headline, you might think that they've changed significantly. But the reality is they're only down by about 0.25%, but 0.25% can make a huge difference in your monthly payment. So the question is, where are interest rates going? Right now, we're seeing interest rates in the mid 5.5% range, and you've got people out there touting that we're going to see 6, 7, 8% interest rates. Well, let's take a minute here and talk about why that's really not likely. Over the last 10 years or so, we've seen the spread between the 10-year treasuries and 30-year fixed around 1.75%. So last year, when I made my forecast about interest rates probably not going as high as 5% and being entirely wrong, that's because I was looking at where the 10-year was at that time and adding the 1.75% spread that we've seen over the last 10 years on average to that, thinking that we'll probably see interest rates in the high 4% range, worst case. And we've seen a lot of volatility primarily due to the Fed and their transparency, or the lack thereof. So the Fed has come out and said, at the beginning of the year, they were going to start to hike the Fed funds rate. And the first hike they did, as you guys have noticed, was 0.25% back in March. Many people at that time thought it should have been 0.5%, but they raised it 0.25%. And then about 2 weeks after they raised it 0.25%, they came out and they said, wow, inflation is way worse than we thought it was. We should have been more aggressive. We're going to be more aggressive going forward. And that created volatility in the interest rate market. Interest rates shot up at that time, and they had already been trending up since the beginning of the year. But they started trending upwards. And, come May, they do hike the Fed funds rate 0.5%, which is what the market expected. And the initial reaction was bad. Interest rates rose, but they ended up coming back down. And they more or less said that they're going to continue to do 50-point basis hikes over the next couple of months in order to help tame inflation. And then this past week, we got news that inflation was actually higher than what they thought it would be, even though it did come down. So the previous month, we saw inflation numbers at 8.5%. This last reading, they were expecting 8.1%. It ended up coming in at 8.3%. The market acted irrationally, stock market got hammered, interest rates rose, but they ended up retracing. So there's volatility all over the market, which is what I want to point out. And so because of all of that, in addition to the Fed announcing that they're going to do, their balance sheet runoff, essentially not reinvest in mortgage-backed securities and let that run off, that's created additional volatility. And because of that, you've seen that spread that I mentioned earlier raise from 1.75% between the 10-year treasury and the 30-year interest rate to around 2.3, 2.4%. So as of today, the 10-year sits just above 3%. And interest rates on the 30-year fixed are somewhere around 5.4, 5.5% on average. That means some people are getting interest rates in the low 5%. That means some people are getting interest rates 6, 6.5% due to credit, down payment, all of that different stuff. But the reality is the average is somewhere in the mid 5% range. So you have that 2.4, 2.3 spread. So that means in order for interest rates to hit 7%, you've got to have, a 10-year at somewhere around 4.5, 4.6% in order to have a 7% interest rate. And if you're thinking it's going to hit 8, then you've got to have a 10-year note at somewhere around 5.5%. I don't see any world in which that happens. Therefore, I don't think interest rates can rise that much. And I do believe that as the Fed actually does what they say they're going to do. They're going to raise, the Fed funds rate 50 basis points. They're going to continue to be aggressive. I think as long as they are doing that and the inflation numbers are coming down, that volatility subsides a little bit in interest rates, and you see interest rates retrace a little bit. As you can see from this chart here, we're trading well above the 5-year moving average on a 30-year fixed. So I think as the volatility comes out of the market, you see interest rates pull back. But that doesn't mean interest rates are going back to 3% or even 4% for that matter. Maybe they pull back to say 5 or somewhere in the high 4s or maybe even the low 5s, and they stay there for a period of time. And that's another reason that we've seen adjustable rates become popular over the last couple of months. That's because their interest rates are quite a bit lower than those of a 30-year fixed. As of today, the average adjustable rate is somewhere around 4.47% on a 5-year adjustable versus 5.53% on a 30-year fixed. So you're saving a considerable amount of money by going with that adjustable rate mortgage. Now, I've done videos where I've talked about adjustable rates. They're not for everyone. You shouldn't consider an adjustable rate if you're planning on being in the property a super long period of time and don't understand the risks that are associated with it. So I'm not going to dive into that in this video. I'll put a link in the description if you want to check out that video. So I want to take a break here and ask a favor. One, I'd like to ask that you hit the thumbs up if you're finding any value in the content at all. The second thing I'd like to ask is to leave a comment below. Where do you think interest rates are going? What do you see happening in the market? I love hearing from you guys. I have two sides. One, people that believe a crash is coming. Other people that believe, no, housing is super bullish, never going to go down. But I'm somewhere, not necessarily in the middle. I'm more on the bullish side, but I love to know what you guys think. So do me a favor, leave it in the comment below. Now, I mentioned at the beginning of the video how higher interest rates are actually a good thing for the housing market, and you're probably thinking, that's crazy. Well, higher interest rates will allow supply to continue to build because it affects affordability. Less people can buy properties with higher interest rates. Less people want to buy property with higher interest rates in some cases. And therefore, that allows supply to build. And supply building allows the market to normalize, not necessarily get back to where it was, 3-4 years ago, but it helps balance the market so that it's not so much in favor of sellers. And if supply can continue to build over a period of time, that might help it go from a seller's market to a more balanced market by creating that inventory. But if you do see interest rates pull back significantly again, which I don't necessarily think is going to happen anytime in the near future, I think that just adds fuel to the housing market, which kind of reignites what we've seen over the last couple of years. And that's not a good thing. We are looking for a more balanced market. Now, for all of those people out there that believe the recession causes a housing market crash, I would ask you to consider what's happened in the past when the Fed has started hiking the Fed funds rate and inflation's come down. You can see from this chart here, interest rates have actually started to pull back in these instances. And at the same time, recessions by nature are deflationary, which means deflation comes down. And we've seen the Fed in the past start to raise the Fed funds rate, start to let the balance sheet run off back in 2019 or 18. And as they did that, the market didn't react the way they wanted it to, therefore they stopped. And I think if we go into a recession, the Fed might try to stimulate growth again. And how they do that is by potentially lowering the Fed funds rate, maybe start buying mortgage-backed securities again to help stimulate that growth. Now, I'm not saying that's going to happen. I'm just saying the Fed has a history of not following through and not getting super aggressive. But hopefully they do enough to tame inflation and hopefully bring those numbers down. And at the same time, hopefully interest rates stay, not high, but somewhere around where they are now, maybe a little bit lower, to allow the housing market to continue to cool a little bit, because that will allow the market to normalize, as I mentioned. And hopefully as things stay in a more normal period, people get the confidence, that to get back in the market. The demand is still there on many fronts. So the demand hasn't really gone anywhere as a whole. There's still willing and able demand. There's just less able demand at the moment because of higher interest rates. But I believe as the market normalizes a little bit and that becomes the new normal, assuming that it does, the market continues to move sideways to up. But one thing I want to be clear here is there is a lot of volatility in the market at the moment. So if you're buying a house, selling a house, just understand the market. As a seller, you need to be a little bit more cautious. You got to be more reasonable and fair in the environment that we're in. And as a buyer, maybe it's the time to get a little bit more aggressive depending on your market. Remember, real estate's local. Some markets, maybe there's an opportunity to be had. In other markets, maybe you're still competing, but just know the market that you're in. But if you're watching this thinking I'm crazy, interest rates are definitely going higher, I actually talk about it in more detail in another video, so do me a favor, check that out here. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.